We start with the markets, as we often do here on NYSE TV Live. We have just over a half hour to go, or just around a little less than a half hour to go before the opening bell. And then just about a half hour ago, the Bureau of Labor Statistics released its June CPI report, revealing the rate of inflation growth last month. According to the Bureau of Labor Statistics, consumer prices rose 0.3% in June, putting the 12-month inflation rate at 2.7%. That was in line with economists' estimates. Now, excluding food and energy prices, which can be volatile, core CPI ticked up 0.2% and then 2.9% year over year, which was actually slightly cooler than what economists were anticipating. All right, joining me now is Clayton Triick, head of portfolio management at Angel Oak Capital Advisors, to discuss the CPI print and more. Clayton, thanks so much for joining the show. Great to have you.
Hi, Caroline. Good to see you. Good morning.
So consumer prices still rising, but largely in line with what economists were expecting. What are your thoughts about that print?
Yeah, it was good to see. On the core side, that's really where we've been focusing, a little bit lower than expectations on the month-over-month figure. Still parsing through the data, but it looks like so far, used car prices were a little bit lower than expectations. Overall view is that you're going to see inflation continue to decelerate here. We made the call earlier in the year and in the outlook that came out a few weeks ago that shelter is continuing to decelerate, right? After huge home price increases a couple years ago, it takes a while for the disinflation in home prices to really flow through to the data, and it's coming through now. Tariffs are creating some noise, but it looks like so far it's not really creating a lot more inflation in the summer months. And so we've been kind of calling for inflation to be sideways and actually surprise to the downside. Doesn't mean it's going to decelerate really, really quickly, but we think it's going to be a little bit lower and set up for potential rate cuts later in the year. So it's really on track for what we've been predicting in our models.
But we don't actually know what the tariff rates are going to be. Now the deadline has moved to August 1st. Obviously, we've seen that 10% baseline tariff. Do you think that it's just that we won't feel the inflationary impact of those tariffs, or we just haven't felt it yet?
Well said. It's a moving target, right? The goalposts continue to move here. But we do think the more extreme tail risk of having a lot higher inflation in the into the second quarter, into the third quarter, we think that is those kind of estimates are a little too high on the tail risk side. So we do think it's going to be not as strong as what expectations are. Also, the stickier data, right? The wage inflation side, the shelter side, which is 30% of core CPI, 30% of core PCE, that is continuing to decelerate, and that's not going to have as much of an effect from the tariffs. So do agree that there will continue to be choppiness in the data from tariffs. Don't think it's going to be as worrisome, as extreme as some of the estimates have been. So lots waiting to be seen, but don't think it's going to be quite as strong, and don't think the tariffs will end up being as high as what is initially has been being negotiated.
Which sets the stage for the Fed to cut rates, as you said. Is that because the economy is slowing too much and the Fed needs to, or just because inflation is going to come down to the Fed's target?
Yeah, really have felt that the Fed is trying to land the airplane here, right? And so they weren't going to wait for inflation to get to 2%. To bring rates down, and this is a different cycle. Usually the Fed cuts when the economy gets in trouble, but they have said that they are restrictive, i.e., rates are higher than they need to be to bring the economy and inflation into balance. And so as they're trying to land the plane, do expect rate cuts to get that rate closer to neutral. A 4.5%, 4.3, 4.4% Fed funds rate's too high, right? You got 2-year yields, at below 4%. The curve is still flat to inverted if you look at 1 month by 10-year treasuries. So they have room to bring rates down, even if inflation doesn't get anywhere near 2. They just want to see the trend here. This happens every year, right? Inflation's higher at the beginning of the year. Everyone says the economy is doing well. And then toward the end of the year, you see the economy continuing to gradually slow, which sets up the opportunity for the Fed to cut rates, even a little bit by the end of the year.
Okay, so I was taking a look at your notes. You're actually finding more opportunities in fixed income than stocks right now. I want to get to those opportunities, but first tell me, is that because you think the stock market is nearing a top?
It's definitely stretched. Looking at traditional multiples like PE, we're looking at the last 4 to 5 decades between high yield corporate bonds, kind of right at its average yield, versus the PE ratio on S&P is closer to 30. So it does look a little stretched. That being said, we do think the economy is going to continue to grow, and companies' margins and balance sheets look quite strong. But on a relative value basis, bonds look really good here. Ripping the Band-Aid off in 2022, we've set up an environment where you're getting 6 to 10% yields in attractive areas of fixed income. Investors have been wanting this for really since '06, right? They've been wanting this for 2 decades, and now they have it. And so we think fixed income looks really good right now. Equities are stretched a little bit. Do like equities longer term, but over the next 6 to 12 months. Fixed income looks really attractive relative to equities.
Okay, so tell us where specifically in fixed income are you finding the best opportunities?
So the easier money has been made in areas like traditional fixed income, right? So in areas like IG corporates, high yield corporates, that money has been made the last couple of years. And so investors have to look a little bit more out of traditional benchmarks. Mortgage-backed securities are incredibly attractive right now. The Fed is still reducing their holdings, and banks have been slow to come back to the agency mortgage market. So we think that is extremely attractive, especially for core investors. Outside of investors looking for a little bit more juice, areas like non-agency mortgages, housing market's still in really good shape for debt investors. Asset-backed securities are really well overlooked, and so we're seeing better opportunities, outside of kind of passive investing, and really active managers illustrating areas like mortgages, asset-backed bonds that show yields that are well in excess of what they usually are compared to the corporate credit market.
Clayton, we have less than 30 seconds, so we have to make it quick, but I do want to ask you, there's a lot of drama at the Fed right now. President Trump is calling on Chair Powell to resign. What would that mean for the bond market if that actually happened?
Yeah, and we think Fed independence is extremely important. It sounds like Bessent was on this morning talking about there's no expectation for Trump to kind of look to potentially fire Trump ahead of his term ending next May. So they are looking for a active transition here, a smooth transition, for onto the next next leader, as you pointed out. So we think that will be smooth, but the process is underway right now. So I think we're going to start hearing about potential candidates, later this year that will set up for a smooth transition next May.
Okay, and we'll leave it there. Clayton Triick, Head of Portfolio Management at Angel Oak Capital Advisors. Appreciate your insights and your picks.